if I'm honest, my suspicion is that this is going to kind of become the new normal. Now, if this becomes the new normal and global temperatures get hotter and that region gets drier and drier, and ultimately this lake effectively dries out over the course of the next 5-10 years, what we're effectively saying is the Panama Canal trade route is gone.
Hi everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, Chief Executive of Onyx Capital Group. I'm joined today with a partner in the business, Luke Mcdermott, who runs the NGL desk. Now, this is going to be a bit more of a technical kind of minutia episode. Luke is right in the thick of things, definitely the number one market maker by volume in the industry in NGL. And has spent a lot of time building his book, building his knowledge, building his presence, and kind of was one of the first market makers in propane in 2016. And it's grown a substantial amount as a market. And Luke's been in there in the thick of things. So Luke, first of all, thanks a lot, obviously, for getting off the desk, and love it when you can do these things, tapping into your wealth of knowledge. But I think for listeners, if we just NGLs, what do we mean by NGLs first off? Because it's not the most traditional market when you think of oil and oil derivatives.
No, thanks for having me. So NGLs, being natural gas liquids, is generally made up of ethane, propane, the more liquid contract, butane, and then C5 contracts as well. Historically, it's kind of generally been an afterthought, kind of a little bit office at the end of the hall in oil production companies. But when we had the expansion in shale and the Permian Basin kick-off, kind of when me and you started our oil trading careers, actually, what was historically an afterthought, kind of give propane away with your cornflakes in the morning, suddenly became big business. We saw Enterprise build their export terminal, which has expanded significantly since even I started trading, to make sure they could get propane from the US, basically where most of the world's production is produced, to export markets such as Asia, where it can actually be turned into plastics, petrochemicals, and ultimately the higher demand centres. It's got a lot of different curves, a lot of different products going on. We've got Europe, as you said, Mediterranean, even Saudi Arabia as a derivative contract is very important in propane, which is not, I don't think they've got another significant contract in oil, and that's another thing that differs. There's a lot of arbitrage going on, a lot of moving propane around the world ultimately, and that's why shipping is so important to the market. And I think this is what we want to kind of tackle today, because shipping has become in the recent news a bit of a theme, and certainly for kind of the wider year in general. So when we talk about shipping, of course it is general freight, general ships being moving material, but ultimately when you get into oil, there's different types of shipping, right? But I think could you frame it for the audience why or what shipping means in NGL specifically in terms of the tankers, and then why that has seen a bit of shockwaves this year? Well, of course, in any different product you have important trade routes. It's kind of, I always like to go back to the physical, because it's very easy as a paper trader to kind of get caught up in paper moves, and that kind of becomes the be all and end all. But realistically what we're enabling is the liquidity for the physical traders, ultimately to lock in a profit margin or trade.
Yeah, fixing their cash flows for an arbitrage.
And so the important trade routes in NGLs, like realistically, are US to Asia, US to Europe, and then you've touched on it with the CP, the Saudi propane contract. They also have a butane, which
heads
contract.
Mostly east, right? Heads most to
Asia. So kind of the Saudi to Chiba in Japan, right. Trade route. So they're kind of the important ones. And what we saw this year was actually Aramco go from term customers to spot chartering. So
term customers where they would just agree long term with
exactly
12 months kind of type of thing.
Yeah, and probably even further than that. But what we got in Q3 this year was a lot of spot demand for ships. And Saudi came out. They had obviously so much product that they wanted to get off their books, and they just came out, lifted the ships, and then moved them to to buyers in the East. What happened was to be honest, the ship availability really tightened. So our propane LPG Baltic rate blew out, and the FEICP, so the difference in price between Asian propane and CP propane, equally blew out, because in a normal market you would expect that to be positively correlated to that freight rate, and that's certainly what we saw.
They came and they wanted to buy a number of ships that the market wasn't used to, the shipping market wasn't used to having to allocate such free-flowing oil, essentially.
Well, like, as in any freight market, you have a certain amount of ships going around the world at any one time.
People get used to that. It's like a supply and demand of ships, right?
Absolutely. Yeah. At the end of their life cycle, those ships get scrapped and ultimately recycled and turned into new ships. So there's this constant flow of how many ships there are in the market.
And in NGLs, natural gas liquid, so it's obviously still a liquid, but how does it compare with the clean tankers and the dirty tankers? Well, can you use a clean tanker?
No, you need a specific
LPG.
You need a specific LPG vessel.
So that being
because ultimately the gases need to be compressed,
right,
to be liquefied, so you can then transport them.
So even less availability, even more niche availability for.
It's a very niche market.
Yeah.
You need your own specific vessel, and that's basically what happened in Q3. Actually, the market couldn't absorb, or certainly kind of ship owners ultimately had a field day, because actually the ship availability worldwide tightened, and ultimately they could charge higher rates just from a simple supply-demand model.
And you don't think the Saudis anticipated this, or they just didn't mind?
Probably the latter. I mean, realistically, I'm sure the Saudis know how many ships there are and ultimately know what they need to do, but ultimately they're also Saudi Arabia. They're producing their propane and butane, to be quite honest, quite cheaply. I mean, they have so much to sell and they have so much to supply.
And why do you think it was such a rush in Q3 to sell what they had?
So historically, we've seen the Saudi have a real dominance of any propane supplies coming out of the Arab Gulf. In recent years, actually, they've having to compete now with ADNOC and other companies who are ultimately trying to muscle in on that and offer Asian customers kind of cheaper deals. So I think Q3 saw the Saudis really attempt to regain a foothold in that market and assert their dominance. They actually sold. There was a series of low CP prints, and they were happy to give these Asian customers actually cheaper propane than perhaps people were expecting. And given that freight was rallying because they were chartering the ships, and kind of any ships available in Q3 were basically going to this export of propane from Arab Gulf to the east. What we saw was actually the FEICP really blew out in Q3, and Q3 in propane you'd normally expect to be a period of low volatility. Often in propane you see the volatility really kick in Q4 and Q1 as you get into that winter period, because obviously propane
more in demand. But do you think the FEICP, that spread, it rallied as a weakness in CP or a strength in FEI with the freight prices being higher?
I think it rallied because of freight and because of CP weakness.
Yeah. And I think one thing that's really interesting, I hadn't really fully appreciated until you've put it as you have, is that people get obsessed with OPEC's moves and what they are and aren't doing on the crude side. But of course, market share in oil is the crude and the products, or anything producers are producing. So I think this is a really interesting insight into, we were considering ourselves on this podcast quite a few times this year, by increasing your cuts and carrying the burden essentially, which was happening in Q3, right? Once again, they were taking the bulk of the new cuts, but losing market share in the process on crude. We're probably trying to regain it elsewhere, which now kind of makes a lot of sense with the propane. Another thing I guess I'm thinking is, if everyone's so focused on crude, but they're building more refiners, which they are, refineries, you can just basically convert your market share into refined product market share rather than crude, as in convert the crude yourself and then export the product, and people aren't balancing it that way. So that's super interesting. Yeah.
It's an interesting, just to touch on your first point about how they were losing market share in crude. What I really noticed when we traded in the middle of the COVID debacle, if you like.
Well, the pricing war with
when basically crude like really sold off on demand, and then you had the pricing war. Right. So when crude effectively was down at kind of 30, 40 bucks, I saw increasingly higher prints in CP, so higher than expected. So again, there might be a little bit of a balancing of the book there, where when actually they need to kind of, when every penny counts, if you like, even for a huge state like Saudi Arabia, like I saw increasingly higher prints in CP than was expected, and that
this is their official selling price.
Precisely. So every month they have an official selling price. What I call the CP print. It's set once a month, generally at the end of the month, and then for that month after, all physical barrels are sold at that price. And actually in that period when crude volatility was extremely high, but ultimately flat price was extremely low, we saw a lot of really quite high CP prints.
Relative to the crude flat price? Relative
to the crude flat price, relative to where perhaps the market thought CP was going to settle.
Really, really interesting. Okay, so we had the FEI, so the Asia versus Saudi Arabian, essentially propane prices, that differential really blew out with freight. But this is the bit I slightly don't understand. So they were quite aggressively selling the CP as effectively FEI, right? Loaded. Well, no, they were selling CP basis Saudi Arabia.
Yeah.
But the oil traders, I guess, were buying it cheap enough that net of freight they were still able to sell it in FEI. That's the bit I guess I'm not understanding.
It's a bit of an interesting one, because when FEICP is so high, the exporters, so the guys ultimately who take this in, there is definitely a break-even level. The exporters, a lot of their domestic sales are priced off CP. So actually they prefer it when CP is settling high, because their domestic sales are higher, which guarantees them a profit margin. Right. When the FEICP blows out too high, and ultimately in Q3, I kind of want to say it kind of blew out as high as $140, the FEICP. Those exporters were definitely losing money. I mean, ultimately, you'd expect it to be significantly lower in Q1. I mean, as of now, we're probably around 55 in Jan. So we're talking about a huge move. And the exporters ultimately were hurting, like partly because realistically their profit margin was completely eroded. So I don't think it necessarily... the Saudis settling CP particularly low, really, it didn't make for a healthy market, or certainly didn't make for a happy market.
So the knock-on effect of this kind of like fire sale of propane in Q3
precisely
was, I mean, so all the differentials, so you had obviously FCI CP like we're saying, but then what happened to the Europe into Asia and US into Asia arbitrage routes?
Yeah, I mean, because freight was higher, because we were naturally in a higher freight environment, because a lot of the ships obviously got taken or kind of went to the AG, because that's where the money was. You had this natural tightening of ship availability worldwide. So LST versus FEI, the difference between US propane and Eastern propane, and LST Northwest Europe propane, those ARBs sold off as well. So again, normally in perhaps a more stereotypical year, you'd expect actually the highest point of the ARB to be Q3, because it's kind of where your demand is lowest.
So people want to get rid of it the most.
Yeah. There just isn't the pull for barrels in the east when it's not winter. But actually this year, like, the ARB very much sold off aggressively in Q3, and then following Q3, we obviously had the news about Panama, which is a completely different issue, but certainly
compounded all, right? Yeah,
certainly kind of worth talking about. So,
but is that just before you do say that, it's in this freight issue? When you say Q3, do you mean literally the whole of Q3 it was happening, or kind of August, September?
Yeah. So we had a series of low CP settles, and I think it lasted July, August and September, which would be August, September, October kind of month-wise.
So then Panama Canal just completely independently kind of kicked off, and it just compounded the impact.
So the Panama Canal issue, like ultimately, certainly, the water levels were low all summer.
Because I actually myself would love to know, as in what is the context around the Panama Canal in general for LP or NGLs?
Yeah, so the quickest route to take propane from the US to the demand centres Asia is through the Panama Canal. Now, historically, again, on perhaps a more normal year, or certainly things that we've seen for the last 3 years, you do get logistical constraints when you come into Q3 and Q1. We've seen cargo container ships and LNG ships in the recent LNG volatility prioritised over LPG ships.
So you've got, obviously, Gulf Coast being a big export region for the crude and I guess some products as well from the US, but this is like the biggest export kind of area for NGLs, is it?
Yeah, exactly.
And that's more South America.
Yeah, exactly. So the quickest route is to take propane from the Gulf Coast, basically the enterprise terminals and the other export terminals, down through the Panama Canal to the demand centres in the east. It takes 26 days to go through the Panama Canal, whereas if you were to go through the Suez Canal, it takes 41 days. And if you were to go all the way around the Cape of Good Hope, it takes 44 and a half days. Right. So it is a significant reduction in vessel travel time, which obviously means that ultimately, if the vessel is having to go through the Suez Canal or around the Cape, you're talking about a significant increase in journey time, which means there's less ship availability, and that's ultimately why freight blows out when we have logistical constraints, be it in the Panama Canal or the Suez Canal.
So suddenly you need to tie up ships for longer voyages, which just increases the tightness.
I think logistical constraints in Q4 and Q1 they're one of those things that are always going to happen, be it Houston fog, which delays the transit of ships through the Houston shipping channel, Panama Canal backlogs, be it because LNG is tight in Japan and there's a power shortage, so all of the gas gets delivered first.
But from a trading perspective, it's like, it's all about, this is what we always go on about, right? When you're trading, it's all about the contract you're trading. So if you're trading the LST, the US benchmark for propane, or one of, and if you can't even get it out to set it on its voyage through the Panama Canal, that's kind of bearish, right? Because you're forming a glut.
It's bearish. Like generally, if you have Panama Canal issues, it's going to be bearish your arb. So it's going to take longer to get propane away from the production center, if you like, of the US, but it also means that you're not delivering propane as quickly to the east. So what tends to happen, actually, just to like throw another curveball, is you tend to find that it's bearish the Bellevue East because of what I've just said, but then there's other export terminals on the East Coast, for example, or even kind of in the Gulf Coast, that then instead of perhaps sending their propane east, they'll send it west. Now, the European market is a significantly smaller market. To be quite honest, unless there's something wacky happening, it can't absorb that level of propane of just multiple cargoes like the East does. So your East-West blows out. So the difference in price between the Eastern propane and Western propane blows out, because actually deliveries that perhaps should have gone east goes to Europe.
Right.
And so
will they do that even at the detriment of like their arb economics, just to get rid of the propane?
That's the one where there's a little bit of like, it depends if they're moving it from a spot. Realistically, if they're moving spot cargoes and the arb economics don't work, then the answer is almost certainly no. But more often than not, you'd say the arb economics, they can make it work. Obviously, what you tend to happen is if LST like kind of is too high and the arbitrage economics don't work, then you just get cancellations and the propane is left in the US. Yeah,
this is the thing. It's so different in a way to other oil derivative markets, because The other product markets, you're always really led by the refinery crack, right, to Brent. So, the economics to actually buy the crude, run it in a refinery and sell as a refined product. But probate, it just is so different. It's so much more ARB-led. But just a question for me as well. When I look at, say, US Gulf Coast crude, and it might be changing now because things have become a lot more competitive, but especially when the Shell oil break-evens were quite a bit below WTI flat price, and certainly into export regions like North Sea, we didn't really... I mean, you can look at the ARB economics and say, well, it's kind of in the money or not from buying it, from lifting the crude in the US and sending it to Europe or wherever. But realistically, they just needed to export the crude because they got too much of it. And so it was a question of just getting as much as you can, but not being so pernickety about which region's going to be able to take it, because it is ultimately about just getting as much out as they can and maximizing the export terminals.
I mean, you definitely have a number of term contracts
where
things move, come rain or shine.
Right. Okay.
Like when the ARB closes, the term barrels still move, and ultimately, kind of the exporters or whoever it was in line to make a lot of money from that suddenly loses a lot of money, and you see a lot of unhappy physical faces. But then ultimately, it is that the kind of... So when we talked a little bit about Aramco going from term customers to spot, that's where, like, realistically, when you move to that spot mechanism, it ultimately becomes proportional to price action, in the sense of how much barrels move will be proportional,
that's in a nutshell.
If the ARB is open or shut. Inevitably, most of these big, like, realistically export terminals and a lot of the big kind of domestic importers and exporters, like they have to have term contracts, because they have to be able to guarantee supply.
But it's the nature of the world we're in, I think, or evolving to. The oil market is always getting more and more sophisticated, but that whole term deal, just to make sure you're clearing it out so you can produce more, and it's just pumping it at maximum to actually you're looking to optimize, and that seems to be this transition, I would say, for ADNOC, as you said, Abu Dhabi National Oil Company, Saudi Aramco, but now even Chevron, Exxon, they're starting more and more to look like Shell and BP as oil traders as well as producers, because there's so much optimization to be done. And as you say, if they're going to be holding back supply or maximize the supply with arbitrage economics that are related to derivative prices, it's massively... This is where we get into, like, the tail wagging the dog. Like, the derivative prices are dictating the physical movement and physical economics, which can't happen with term deals, but it can happen with spot. So it almost seems like every oil market needs to go through this, or does go through this development process.
Yeah, I think once you get kind of to the prompt stuff, though, I don't disagree with you, because I do see the tail wagging the dog, but I think when you get prompt, the physical just naturally takes over. Like, the paper contract can only price out where the physical contract is, or where the physical barrels are. So
forward ARBs is what I mean. If they're open on paper in a couple months' time, people are going to lock that in and maximize their physical movement of barrels, and that's going to...
I think that's the interesting thing. So kind of even now you kind of look at kind of like the Cal 25 curve, and actually those ARBs look to me like, if anyone's interested in hedging, they should be buying those Cal 25 ARBs, because they lock in what they need to do. The freight curve implies a steep backwardation for obvious reasons, Suez Canal, Panama issues, perhaps kind of 20 more ships coming online in 2Q, you'd expect lower freight with that increased competition, if you like. And that's the one thing that the paper contract enables you to do. It's just like, if that works for you in that moment of time, where you can hedge your freight as well, then that certainly makes sense.
And do people do this trade?
No, is the honest answer. They don't do it because they're often they're only really kind of concentrating on, like, the first 3 months.
But again, this is another step of development we'd expect in a market becoming more sophisticated.
Yeah, you see a couple of, as you say, kind of, you've mentioned some of the names, but you do see some people kind of a little bit more forward thinking, where kind of when your Cal 25 ARB is on its knees, like you see them coming in and trying to hedge significant size. Having said that, over the course of the last 2-3 years, if I'm really honest, some of the people who have done it have also got burned, because we went from realistically a low freight environment to a high freight environment, and if you're hedging, then you get hurt. Having said that, if you have the ships, you have like ultimately the need, like that is exactly what that is. It's a hedge, and I think ultimately we've seen it historically. A really good example is the airlines in America who don't hedge anymore because their airlines hedged and then they lost a load of money one year
on the hedges and the fact that they couldn't offset that with increased ticket demand.
Yeah. So they don't hedge anymore, but then they've also seen crude go from 40 to like in the Russian war 120.
Yeah.
And the firms that did very well are the like ultimately the European airlines who did hedge or certainly hedged 80.
Right. It's got a systematic hedging approach.
I mean, all of the European airlines generally hedge. So again, the year that crude sells off from 100 to 40, your hedges, you look like an absolute knob, to put it bluntly. But the year that it goes from 40 to 100, and as we know, commodity markets are cyclical and they will continue to be cyclical. So, I mean, realistically, if as a firm you understand that a hedge is a hedge, and you're not an idiot if you lose money on your hedge, and in the same breath, you're also not a rock star when you make money on your hedge. Yeah. It's just guaranteeing profit margin.
But the big thing you're adding there is for propane exporters, it's the freight component, which obviously been proven this year is so sensitive. So even if you have hedged, well, not correctly, but timely, you can still get burnt because of the freight component, unless you hedge the freight paper as well. So we've had this a few times as like market makers, liquidity providers, however you want to say it. We've had majors, traders say, liquidity is great. This is great that like niche contracts are being more liquid. It allows us to more lock in arbitrage economics, that kind of thing. But it'd be great if you could trade freight as well, because that would complete the arbitrage hedge. It's something we've looked at here and there, but it's a very difficult market to trade the way we trade oil. I don't know if that will change, but if it did, that would probably encourage more of what you're saying.
Yeah. I mean, a lot of the irony is a lot of the guys that are hedging and buying the arb are ship owners. So it is a hedge.
Because they've fixed the freight themselves already.
Yeah, exactly. By doing that, they have guaranteed ultimately a profit margin because they own the ship. So the irony is that the world or the companies, we kind of laugh about it in the market. Everyone's always naturally short arbs because everyone's ship owners and everyone has to move barrels from there to there. So you also see when the East is weak, actually a real panicking buying of arbs because the market cannot absorb that amount of arb buying. So this is why I find the irony when actually the arb sells off aggressively, particularly as far forward as Cal 25.
Because you know that they're effectively...
You know that somewhere in between now and Cal 25, there's going to be guys running over each other to buy prompt arbs.
Yeah, this is the trading game in general, because you've mentioned it really nicely, the kind of thought process. And then the thing about the Cal 25 position is... it's also margin calls, and you've got to put, even if it's a credit line, you've got to put a lot of cash behind, or potential cash behind this position if it goes aggressively against you, and you've got to wear that for a year. It's still probably worth it if you do the maths, but ultimately it requires an understanding and a commitment to that, and they might just think it's just on balance not worth it, and you can forgive them for that ultimately.
No, I think that's a completely fair point, and ultimately we've seen it again over the course of 2 years. You consider some big trading houses that got caught short on margin calls, trading LNG arbs. I mean, one springs to mind. I'm sure you know who I'm talking about. And actually, that is always the danger when you trade this market. If suddenly something unforeseen happens that you don't expect, and ultimately you've got it on, and then like realistically you get a call from your bank saying, well, either give us the margin or trade out of your position, then it's an uncomfortable place to be. So I completely see it from both sides of the
also makes your role so imperative, because I've heard it from themselves telling me, if Luke wasn't there in the market to take down what I needed to get out of when I was losing money or getting margin called, it would have been over. So that liquidity is it's the most important thing in most extreme times. And obviously you know very well, like what we're trying to do here at Onyx is not just be the classic arbitrage trader, curve stripper, because that doesn't really add anything to the market beyond kind of a narrowing or more efficiency. But the ultimate service to the market is, in extreme scenarios, you still get the liquidity, and that's...
Yeah, I mean, I think a proper market maker is there like at all times, whether you're losing. I know the example that you're talking about, and I mean, I think I was losing a significant amount of money that day. So it's kind of a case of you're making markets come rain or shine, because you know that ultimately, kind of for the rest of the year, you're still making markets and other people are happier. But realistically, if people need to exit a position, they need to exit a position.
You're going to be doing the churn, and ultimately it averages out. I mean, I genuinely see it as a service. I think just that's all like interesting. So the Panama Canal, I think we need to talk about like the actual what actually happened.
Yeah, right? That is kind of the purpose of the podcast. We've been distracted quite nicely, rabbiting on about the NGL world, but the Panama Canal is really interesting, and I think this year issues are completely different, and issues that are ultimately a function of the changing world that we're living in due to global warming. So Gatton Lake water levels in the Panama Canal have got to the point where they are extremely low. Average water levels for the past 5 years, which is the peak water level season, if you like, in December and January, have been 27.3 to 27.2 feet, and that's before we get into the dry season. Now, as it stands currently, towards the end of December, 20th of December, the Gatton water levels are at 81.4 foot, which is significantly lower what you'd normally expect the water levels to be during the dry season in April and May. So on average, for the last 5 years, the dry season, the lowest that we've seen those water levels being is 83 feet. So we're already kind of the best part of 2 foot below those numbers. So what's really happened is, I mean, the Panama Canal is obviously doing all it can to prevent logistical issues, but it's had to scale back the amount of boats that it lets through the canal for this reason. Now, they just have not seen the rainfall in that area between kind of Q3 and Q4 to replenish those water levels, but to the point now it's getting critically low. So if we expect to see a normal lowering of that water level as you go into the dry season, come kind of and kind of start of Q2, that the water levels are going to be extremely low. What's interesting about this is it could be a 1-year black swan event, but if I'm honest, my suspicion is that this is going to kind of become the new normal. Now, if this becomes the new normal and global temperatures get hotter and that region gets drier and drier, and ultimately this lake effectively dries out over the course of the next 5-10 years, what we're effectively saying is the Panama Canal trade route is gone. So you go from moving propane, which takes 26 days, to even if you go through the Suez, even if there aren't any issues in the Suez Canal, you're talking about 15 days extra, which is like ultimately the best part of 40%. It is significant. It means we're going to live realistically in a higher freight environment until new ships come online.
Which the lag time for that?
It takes about 2 years to build a new LPG ship. Now, obviously, I mean, they have about a 25-30 year life cycle. So not only do you need new ships, you also need to replace the ships that ultimately are being decommissioned as well.
I think nothing drives like demand or like people taking action like economics, right? Ultimately, so
100%. The ship owners this year have made a lot of money. A lot of money. There was a point, I can't remember what month it is. I think it was probably in August and September, when the Saudis were buying all their were chartering in the spot market. I mean, I think you could make back the cost of making a ship in a few months.
Wow.
It was that extreme. That's how high the freight was.
You've been pushing me and Omar to buy a ship.
Yeah, I mean, I don't know why you won't buy me a ship, to be honest.
Yeah,
I mean, but we kind of laugh about it, but nothing does drive like businesses to think about this like money, and actually if we go into that that environment, then it's going to make sense to buy a few ships, whether it's second hand or just make them.
No, it's compelling. And for next year, then, I mean, so you had obviously there's two things: the switch in the Saudi mentality to spot market, then the Panama Canal, all but very unexpected. The Panama Canal situation.
So I'd say generally the market, the kind of the smart money. The smart money expects logistical issues in Q4 and Q1,
okay.
Whether it's Houston fog, whether it's Panama Canal issues. But I'd say what the difference this year and the previous years, people have expected those Panama Canal logistical issues for, as I mentioned, container ships and LNG ships getting prioritised. But actually, I think the water levels was a brand new story. So I think it was expected, but the level of disruption that it caused was like even took some of the kind of the other guys off guard. Having said that, having spoken to some of the senior traders around the world at big trade houses, I think people did well out of the move.
Okay, interesting. But you had those two events, so freight is really kind of reshaping in NGLs quite significantly. And then what has the recent kind of Red Sea stuff done to the market?
Yeah, I mean, the Red Sea story is significantly more important in NAFTA again. So we talk about trade routes, and ultimately that Red Sea trade route is very important because you see NAFTA go from Europe to Asia. That's one of the main trade routes for NAFTA. In LPG or NGLs, realistically, I've mentioned that the Panama Canal takes 26 days, Suez takes 41, and then going around the Cape is 44 and a half days. So it's basically 3 days extra. So it is certainly bullish freight. It is more bullish freight, but the trade route, what really we're going to see is the guys that are going to can't get their ships going through the Panama Canal, and kind of come January, very, very few, if any, NGL ships are going to be going through the Panama. It just means that as long as they set off, as long as they don't get halfway, like kind of the Suez route, and then have to turn around, you kind of add in about 3 days to the journey. So it's bullish freight, but I wouldn't say it's hugely significant. It just makes that extra kind of
volatility in the shipping.
Yeah, it's just that extra.
Interesting to say about naphtha, because the FEI versus MOPJ, so the Asian propane versus Asian naphtha, did in fact sell off quite significantly recently, which would make sense. As you say, it's more sensitive to naphtha, so essentially it's harder to get the naphtha over to Asia, so it's more expensive on a relative basis.
I mean, that's been for a few different reasons, and not necessarily the reasons we're talking about.
Okay.
Spot MOPJ has been extremely strong. We've had some turnarounds in the AG, so that supply hasn't come. Prompt MOPJ has been extremely strong. And having said that, we've also seen some Chinese PDH units cut back on run rates in the petrochemical world, because the petrochemical margins have been quite weak all year. Again, you often see the Chinese running because they need the cash flow. So just because there's a weak PDH margin doesn't necessarily mean that they do cut, but we have seen some run cuts the last few months, and then that Chinese reselling has caused Asian premiums to be extremely discounted, and particularly for this time of year. I mean, we're talking about December. It feels like the market was just caught a little bit long December physical barrels. So we've seen a number of trade houses offering the physical deck FEI down to -20.
So there's independent drivers as well as
that's where actually just the independent product physical market has kicked in really, and that's why you've seen that.
But we're getting to levels that you would consider attractive from a switching perspective from propane to naphtha?
I mean, I think the prompts. Well, I mean, December is certainly negative. I'd say kind of really attractive levels are probably sub -20 to -40. Having said that, I would expect the levels to firm from here because I'm expecting logistical issues going into Q1. The Panama story, ultimately the market even now doesn't really know how to absorb it. I don't even think some of the best traders in the world really know how this is going to impact FEI barrels kind of going into Q1 and Q2. All I know is that I'm expecting it to be volatile, to be honest.
Does this do anything for if we think about the end user now? So in Asia, obviously, it's more difficult to get it's a demand region. It's more difficult to get its propane. So it's obviously kind of bullish and probably quite painful potentially for them going forward. But on the flip side, the US should be looking to maximize their domestic consumption, or at least pushing them to do so. And the same with Europe. No, we should actually get lower. If it's used at all in heating, it should be quite competitive, no?
Well, the additional production that we've seen from the increased shale volumes, the increased Permian Basin production because of the flat price environment, has seen propane stocks get really quite high. We have a lot of propane in the US. We're certainly not going to be tight this winter. I'd expect production to stay high for the next year at least for the US production story. So I wouldn't expect us to get tight propane next year. The only way propane can really get tight in the US is if they export all of the barrels. And now, in order to export all of the barrels, you need the demand from Asia.
And the shipping routes to be low enough.
Yeah, well, I mean, the freight can be wherever the freight wants to be, but as long as the demand is high enough, right, then it pulls those barrels from the US.
I guess that's what I'm saying. Is in like if it continues like this, you could get a scenario where you're kind of oversupplied in the US if it doesn't have the overall tightness in supply.
I mean, I think we're already oversupplied. To be honest, we've been oversupplied all summer. The thing that we haven't had this year yet, as opposed to previous years, as we go into kind of like the last month of Q4 and going into Q1, we haven't had the tightness in the east. We haven't actually had very much demand from China. Now, I've seen a lot of bargain basement Chinese tenders the last few weeks because of the extremely steep discounts that we've seen the last few weeks. So whether some of that demand is going to come back into Q1 remains to be seen. But unless that demand really comes back out of China and in the east, I think realistically demand drives everything, and I think it would be a very bearish situation for propane worldwide.
But this is the thing, or kind of what I said at the beginning of the podcast, which is we don't look at NGLs much. It's almost like it's not considered much with oil, but it's not considered much with gas as well, heating. But it does have knock-on effects, and I guess it's just for me it's really interesting because it's not obviously that closely related to power and gas, but it's enough of a relationship where you switch from, there are still like big areas, demand areas that use propane for heating, and ultimately, if you're running out of reasons to basically say that we're tight and that a war or exacerbations in wars and geopolitical premiums could really cause another shock in power and gas markets, that we're still elevated is what I'm saying on those prices. So we're still in like a risk kind of world with those, and it's a very, very dangerous thing to be short power, right? I think we know enough of, to know that, and of course with TTF and natural gas, what it did last year as well. But I guess this propane story does kind of feed into it, because it's not like you're at the peak of last year where you're like, we literally don't know where we're going to get our heating fuel from. We're screwed. You can't say that. And I know propane wouldn't like completely replace everything, but if the storage is filling up and we've had the warm winter, things like Panama Canal are telling you that, right? There's not the same pressures on us from a weather perspective for heating. There's also a lot of supply. There's also kind of diminished kind of conflict or like contagion from the conflicts. So it does kind of add, in my mind, a bit of weight to the argument that the rebalancing of power and gas prices down to normality or pre kind of 2021 levels could be on the horizon. I know it's a bit of a tangent, but that's kind of...
No, I think it's fair. Like the one thing we've had this winter, or where we are right now, which we haven't had for probably since we haven't had a proper El Nino winter since maybe 2016, and it's a strong El Nino winter. So an El Nino winter being generally kind of a chronically warm winter. Now that's not to say you won't have a polar vortex event, and we might well still have that polar vortex event where it gets very, very cold for 1 or 2 weeks. But with the El Nino winter, generally you just don't have that continued demand for like heating fuels, so be it distillate, be it propane, be it kerosene in Japan, whatever it is that an individual country uses, and realistically you're just not going to see the same drawdowns of propane stocks for that reason. So we might have that 1 month where like a spread blows out because you have acute demand for a couple of weeks. You don't, particularly if freight is doing something funky in that moment, if you don't have those barrels that week or that month, then that spread will certainly blow out. But then realistically you go back to what you can only really describe as a high production environment, and the demand is going to be completely reliant on China and petchem plants worldwide. And this year, because actually realistically we haven't really had a huge amount of growth anywhere. The interesting thing about propane and the Chinese PDH demand is like realistically it's quite a good bellwether of what the Chinese economy is doing. Are they building? Are they using plastics in new houses, in water pipes, in whatever they use plastics for? And actually the petrochemical prices haven't really performed this year, a little bit like everything. Now obviously at the start of 2023 there was a huge expectation that China was going to come back with a bang, everything was going to be back post-COVID, and there's going to be huge growth, and it just turned out to be a damp squid, and Chinese are struggling ultimately to grow their economy, just like a lot of other major economies are struggling to grow their economy.
So I love what you said there, because that's what I'm saying, like propane might be this thing that people don't look at very much, but it's so indicative of what's going on, especially with its relationships with naphtha, with gas and all that. So the only thing I would add to that is doing the rounds at the end of the year, what people are thinking for their supply and demand forecast for next year on crude, and I guess the kind of proxy for general oil prices is that, I mean, everyone seems to always want to be bullish in these circles, but ultimately they're relying on increased demand from China next year. And when you break down that demand, being in the situation that they're in with property and the rest of it, it's quite hard to believe. And as you said, that it's just not the evidence that they're hoovering up these kind of cheap things and really putting their economy to work. So I think that's a super interesting point.
I mean, I certainly think if we see a lower Brent flat price environment, you're going to see some of that demand come back. Right. Because the one thing the Chinese do very well is they buy things when it's low, and they run and they take
the long-term view.
Yeah, they do, and they do that well. Like, I mean, realistically, when, again, going back to COVID, those guys like really, really bought a huge amount of crude. But then when we rally up to 80, 90, 100, there's often this story, when the Chinese come back from the holidays, imagine how high we're going to go. It's just not how they work. They buy it when it's cheap, and they produce what they need to produce, and then when it gets high, that they sell it all out. That they continue to run, so that for those reasons that I've just discussed, it often enables them to run, perhaps when you kind of look at margins, be it petchem margins, PDH margins, refinery margins, whatever it is, because they have that kind of business model where they just fill up the tanks effectively when it's $40 crude. It perhaps enables them to run significantly longer than, say, a European refinery that's very hand-to-mouth. They buy the crude now, they run when they can make $1 or $2 refinery margin, and then suddenly when the cracks sell off or crude goes up and those refinery margins turn negative, they have to cut the run rates. But they have to cut because they haven't bought the crude as cheaply with that medium to long-term view in mind.
That's against pretty much every other trading nation, or at least oil trader as well. Like I can understand why that's hard to understand, but that's super interesting anecdote. But we'll leave it there because that's just so much, and like really appreciate your time. Again, I hope listeners out there definitely more technical, and certainly kind of shine a light on my lack of knowledge in this area as well. So I found that very, very interesting. So everyone out there, thanks very much for listening. Thanks, Luke, for your time, and see you next year.
Merry Christmas, everybody.